ready to raise rates.
Interest rates.
They're going to raise rates.
Raising interest rates.
The Federal Reserve is the most powerful financial institution in the world, and their main weapon, monetary policy.
So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
I'm going to bring you 5 ways the Fed uses monetary policy to drive stocks, crypto, and the overall economy. Welcome to Mind Growth. I'm your host, Jay Fielder. Let's get into it. And first up, we got the Fed's balance sheet. The Fed's balance sheet reflects how much cash is being pumped into markets on a monthly basis. Think of the balance sheet like a credit card. When you use it, your balance goes up, reflecting how much money you've injected into the economy. So the Fed's balance sheet reflects the amount of cash pumped into markets, and the market loves free money, especially stocks and crypto. In 2009, the Fed used the balance sheet to juice the markets. And again, during the pandemic. In blue, you can see just how much the stock market loves when the balance sheet grows. And the same for Bitcoin and crypto in general. But what happens when you remove the free juice? Does it look like stocks want less juice?
Nope.
Does it look like Bitcoin wants less cash in the system?
Nope.
So the 2020 ramp up in the Fed's balance sheet perfectly corresponds to the 2021 stock market mania.
And next, we got interest rates.
At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%.
The Fed funds rate sets the cost of capital for markets. In other words, interest rates. And interest rates determine how expensive it is to borrow money. And trust me, every company on earth borrows money. Apple might rake in $365 billion in revenue, but they still pay interest on the $94 billion in long-term debt. So when the Fed raises rates, demand for borrowing falls, existing debts rise, and economic growth slows.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
Although higher rates are restrictive to growth, cutting rates is accommodative. The Fed will cut rates before or during some type of financial crisis. In 2000, the Fed cut rates after the dot-com bust. In 2008, the Great Financial Crisis, and once again after the COVID crash. Inflation caused the Fed to raise rates once again. Now we're at 2.5%. Where do we go from here? QE stands for Quantitative Easing, when the Fed decides to cut rates and inject cash into the system at the same time. QE must be used responsibly. Too much for too long results in significant amounts of inflation. With rates near zero and a climbing balance sheet, housing prices pretty much exploded. So did gasoline prices and eventually inflation.
And if the economy breaks in the process, so be it, because he can't stand the pain anymore. He can't stand the pain that inflation is causing so many people in this country that...
QT stands for Quantitative Tightening because the Fed tightens financial conditions by raising interest rates and reducing the amount of cash. Keep in mind, the Fed had to use QT to combat inflation. And as you can see, stocks sold off right before QT started. If you look at crypto, it actually peaked when the Fed first announced it would start QE in November. The truth is, markets don't wait for the Fed to make decisions about monetary policy. They price in expectations well before the decisions are made. Every week, the Fed speaks about the economy, and markets listen for hints about what they're going to do next. Professional analysts, investors, and media try to determine the Fed's tone. Were they more hawkish or dovish?
Sure, here, this was a hawkish speech, full stop. The Fed chair said his message was, quote, going to be more direct.
Hawk or hawkish are code words for tightening, higher rates, less cash. Dove or dovish are code words for easing, lower rates, more cash. And now you know, the most powerful financial institution on earth uses monetary policy to control interest rates, the supply of money, and market expectations. I'm gonna leave a link in the description that dives much deeper into policy economics. Thanks for watching. If you learned something new, please like, subscribe, comment, and I'll see you on the next video.